Hello, my name's Charles Delastic. I'm the Managing Director of Blue Bond Group, and we have been inheritance tax specialists for more than 18 years and have helped hundreds of clients save millions of pounds on their inheritance tax planning. So dealing with landlords and property portfolios is one of our areas of speciality, and today's video is around how you can build a very tax effective property portfolio. So how do you build a tax-effective property portfolio? Now, due to the implementation of Section 24 and the impact of mortgages on rental properties portfolios, many landlords are much more aware of the taxation issues around their properties. And a lot of accountants are telling people to put properties into a company, but that's not always the most tax-effective way to deal with this particular issue. So, for example, if you are already a basic rate taxpayer, a limited liability partnership might be a better solution for you if you are depending on the income from your property portfolio to maintain your lifestyle. Because if you put properties into a company, although you can offset the mortgages due to Section 24, the extraction of that rental income is at a higher rate by the time you've paid the corporation tax and then you've paid the dividend tax. So extracting the money, owning the property personally through a limited liability partnership might be a much better option. However, another way of mitigating the tax liability, apart from a company or an LLP, is putting £60,000 into pension schemes, which is now the new limit that you can put in there. Now, if you happen to have, or you decide you're going to put your properties into a company because you're not entirely dependent on the income stream, then of course that becomes really tax efficient, because now the rental income from your property portfolio, if you're putting up to £60,000 into a pension scheme for either yourselves or your children, is very tax effective, because there is no corporation tax on that money. It goes straight into a pension as a deduction from the company. Then, of course, that pension scheme over time, as the money builds up in it, can be used to buy commercial property. So in your company, you've got normal buy-to-lets, or personally in an LLP, you've got normal buy-to-lets, and then you start to build a commercial property portfolio inside of a pension scheme. Now that is very tax efficient, because all of the rental income is not contributions to your pension scheme. That is just the asset producing an income stream, and therefore all of that rental income from that commercial property is completely free of tax in your pension. And let's say after 15 years your commercial property has doubled in value, then all of that growth is completely free of tax as well, because it's in a pension scheme. And people say, well, I can't borrow money. Well, you can. Once you've got the value up, it is possible for a SIP or what's called a SAS to borrow money against a rental property portfolio. And you can use up to about half in a SIP of the value of the SIP to borrow from that SIP. And that SIP can borrow money to help you fund a property purchase. So, in summary, pensions are a very strong possibility for holding property portfolios if you want to diversify from normal buy-to-lets into commercial properties. And not only is that diversification potentially sensible, because of the amazing tax benefits you get within a pension scheme, it might be very efficient to do it that way. So, putting money into pensions, especially if you are a higher rate taxpayer, is also a sensible thing to do anyway, whether you're doing that through a company or you're doing that personally. But I'm merely suggesting that if you are a property landlord and you don't want to go into stocks and shares investments and the stock market, you can effectively use your pension scheme to buy commercial properties. Okay, hopefully you found that useful. Thanks for listening, and bye for now. Bye.